Hey guys, welcome back. Today I'm going to cut to a laptop sequence and I'm going to show you how to build an aggressive portfolio. This is based on a portfolio I set up about 4 years ago. Obviously there's a few things I would change if I was to build it today, and I'll talk about those during the filming at the laptop. So sorry that you're going to watch a spreadsheet for a few minutes, but that's what we have today. Okay, so here we have an example of an aggressive portfolio that I built roughly 4 years ago, almost to the day. These stocks were purchased in March, April, May of 2020. When I say aggressive, I mean there's a high chance of volatility in the price movement of these stocks, not necessarily chance of it going to zero. That's not the type of risk we were taking here, but with higher volatility typically comes, or the potential for higher gains anyway. So the first one, ITA, is a ETF for the American Aerospace and Defense. I think it's 39, 40-ish companies in there. Lockheed, Boeing, General Dynamics, and many others are contained in there. I put a small foot in there, as you can see, 5% for the weight of the stock in the portfolio. So really not too much, but I wanted some exposure to it. Next one, ATD, is Alimentation Couche-Tard. It's a brand of convenience stores in Canada. I don't know if they exist in the US, but they've had a very good track record for growth. So I put some in there, roughly 10% of this portfolio segment. Next up, WSP is a construction management company. Not much to say. TFI is a freight movement transportation company. TSM, Taiwan Semiconductors, they are responsible for the production of roughly 90% of all of the most advanced microchips in the world. Intel and NVIDIA and AMD, they design the chips, but the actual physical production usually comes from Taiwan Semi, with the exception of some Samsung chips, which are produced by Samsung themselves, but that represent roughly 10% of the market. So a really big exposure, as you can see, to the semiconductor market. Next up is Google. Moderate position, nothing too crazy, but I do think that they still have a big place in today's internet and e-com, so we got some exposure there. After that, Costco, retail giant, probably going to outlast most of the other physical retail shops. You know, we've seen Kmart, Sears, I think Target is out or partially out, Zellers is gone. So I really think that Costco might be the last standing one as the retail landscape changes. And then GIB is CGI, a IT management, many other, I think, management things. And there you have it. So those are the companies. You can see the weight, how many shares I purchased, the average purchase price, the book value at the time. Now I did round some of these numbers because I didn't want to do too much decimal work. The price today and the market value today. So as you can see, we went in with 20,000 and we came out now 4 years later with 65,300. That's a rate of return for the 4 years, or for the period, of 226.55%, which is not bad. You know, uncompounded, about 50% per year return is very good for a aggressive build, higher risk portfolio. Now, not all of my money went into this portfolio structure, obviously, and I don't encourage you to do that as well. Only dedicate a portion of it, maybe the portion that you're willing to lose completely, or a portion that you're okay if it's down for an extended period of time. Second, I can't say that the stocks here, these 8 companies, will have the same track record over the next 4 years. So this is not a recommendation to build this portfolio today. It's a retrospective of the last 4 years of this portfolio and an example of what that portfolio would look like in the future. Thanks for watching, and please subscribe.